Before we start the show, please remember that the XX Foundation is a sponsor of this show. Please remember I am not a financial advisor. Fascism should more appropriately be called corporatism because it is a merger of state and corporate power. Mussolini.
Stimulus packages that were enacted over the last year, the Infrastructure Act, the CHIPS Act, and the IRA, it's all just starting the J curve. This is going to, and it was $1 trillion over many years, though, but of stimulus. It's just entering the economy.
It's been too much.
Yes, but it's entering the economy. At the same time,
the cycle of spending that. Do you know? Halfway, 3/4,
5%.
Whoa!
That's it.
We're just starting, Charlie. This is just happening. And so think about how many jobs it takes to rebuild airports and freeways and ports.
You have fiscal policy and monetary policy. The government, the treasury, is fiscal policy. You have the government spending like a drunken sailor. And according to Larry Fink, only 5% of the trillions that they spent actually came into circulation. At the same time, monetary policy, or the Federal Reserve, is tightening. They're making interest rates higher. They're taking treasuries off the market. They're purposely putting stress on the market while the government is printing. So you have a recipe for high inflation at the same time, really bad market condition.
The job demand from these acts is going to be enormous. And so here we are talking about commercial real estate as it may be a problem, but the stimulus that we're going to see in the other parts of the economy is extraordinary. And owning companies that are involved in the rebuilding of our infrastructure, these are going to be good long-term holds.
This is a chart of commercial mortgage-backed securities and the delinquency rate. Look at the spike that's starting to occur. Think about the environment of high rates while 95% of the fiscal stimulus entering into the economy. You have one hand tightening while the other hand is loosening. The foundation of the banking system is set on treasuries and mortgage-backed securities. This is collateral of the banking system.
Look, I think the risks that will hit us in 2027 or 2030 are going to be different than those that we experienced in 08. The world's always changing what's going to catch you off guard.
Sure.
So I think that 08, it's still in everyone's stress test numbers. It's a moment in time that I'll never forget. But I think to be myopically focused that that's going to be what happens next is a real mistake. I mean, look at, for example, the UK government bond crisis just a few months ago. That was terrifying how the long-dated gilts market just went into complete disarray.
We noticed.
Right? So is the next crisis going to be a similar dislocation in the U.S. Treasury market? History in finance doesn't necessarily repeat itself. It does rhyme. And what we're always thinking about is where are we seeing in the world signs of changes in market structure, market dynamics that should give us anxiety about what might play out next here in our core portfolios in Western Europe and the United States.
This is England's gilt market. It's like the treasury market, but for the UK. Right around here, the Bank of England put a floor underneath the bond market, but still we see this decline in price. That's because investors are worried about their long-term portfolio. What happens when all the inflation, all the policies are put into place? That's going to erode the purchasing power of these currencies, and they sell their bonds at a discount because they don't want the inflation to come in and erode the portfolio. So TLT is the US's version. You could see here it's starting to decline. Now, the Bank of England stepped in somewhere around here, and we're starting to see a yield spike. Is the Fed going to step in and reverse policy? What happens to inflation at that point?
Perfectly. I believe interest rates are going to continue to go higher. I think the Federal Reserve is going to have to do minimum of 2, but maybe as much as 4 more tight.
More rate, 25 basis points.
25 basis points, another 100 basis points. I actually believe inflation is stickier and more structural. And so I see a future of higher interest rates. Higher interest rates is going to create more stress in commercial real estate. Mm-hmm. Commercial real estate is the largest asset category of regional banks. And so there may be stresses.
That's a problem.
But the first three banks did not have stress on credit. They had stress on their mismatch of their assets and liabilities.
Larry Fink is saying that the Fed will raise interest rates by another 100 basis points. That means mortgage rates will be around 9%. He says this is going to be an incredible stress on housing and real estate. Housing, like I mentioned earlier, is bundled up and sold to banks as mortgage-backed securities. This is collateral. There is derivative market after derivative markets based on real estate. It's a tremendous amount of leverage involved with housing. Housing and real estate moves very slowly, and this is what broke the back of the economy in 2008. When housing imploded, everything followed. The XX Foundation as well as the ALGO Foundation are working together in a new collaboration. They're going to be exploring quantum security as well as privacy and utility mechanisms that benefit both the ALGO and XX communities. Quantum computing is coming at one point. There's been major strides in quantum computing. As a matter of fact, DC has put out memos for all of their staff to upgrade their software to quantum-resistant VPNs. Quantum technology has the capability of breaking modern-day encryption. So it's really important that a lot of these crypto assets take quantum seriously, and Algorand as well as XX are kind of leaders in that area. And I also believe IOHK, which also works with the XX Foundation with the product sleeve.
Larry, as we look at the broader market here,
Right.
We have come out of a bank crisis. I don't know, it was a mini
crisis,
fit or something like
a little
that.
mini.
It didn't feel mini to the banks that went under, three
Correct.
of them.
Yes.
But the very issues that put those banks under, whether it was bank management in relation to higher interest rates,
Correct.
have not gone away. Now we've got the roller coaster coming right at commercial real estate.
Yes.
Are there more banks that you foresee failing, whether they are the regionals? We just talked to David Rubenstein at the top of the show,
Sure.
and he thinks maybe in a couple of years we will see some of these go away.
We have 4,400 banks. We have more banks in the United States than any country in the world. We believe in local banks, so we have a strong foundational belief that local banks are good. But to have 4,400 maybe is too many. But to have 4,400 maybe is too many. But to have 4,400 maybe is too many.
Larry Fink is telling you that more banks are going to fail, and that's the plan. By now you realize that the whole scheme is to centralize. It's to take all the small banks and merge them together into one large centralized bank. Now, I must say that this bank failure means that there's going to be a lot of losers. Everyone that puts money into the bank, including other banks borrow to each other. Those banks are going to lose. The banks that fail, they default on all their obligations. Now, what happened with Silicon Valley Bank? The government stepped in and made everyone whole. They took all of those losses and put it onto the Treasury's balance sheet. They put it on the government's balance sheet. That's going to happen again. Fink's saying there's 4,800 banks. It needs to slim down. They want to centralize the entire banking sector, and the government's going to pay for it. Now, 95% of the spending hasn't even hit circulation. What happens when we tack on another when they bail out the banking system and tack that onto the bill? This clip has been removed for copyright strike, and apparently London Real is claiming that they own the copyright to this clip, but that's not true. So Brian Rose is claiming that he owns the copyright, but I'll translate this clip. Fink said that he was skeptical of Bitcoin because it was used for illicit purposes. And then he goes on to say it's going to replace gold. Bitcoin is digital gold. Crypto assets at large are replacing the need for gold. He says the role of crypto is digitizing gold, using crypto as a hedge against devaluation of currency. He says Bitcoin is an international asset. He says BlackRock's foundation is based on hope. If you invest today, it's because you have hope for tomorrow. We are currently facing an issue with inflation, and BlackRock has recently applied for a Bitcoin ETF. Simultaneously, regulators are intensifying their actions against crypto leaders. Binance is being sued, and executives from various companies are stepping down. Kraken's Jesse Powell is under investigation for allegedly hacking a nonprofit organization. Both Gemini and Coinbase have also faced lawsuits. The crypto industry is experiencing a period of cleansing or potential corruption as traditional finance banks and CEOs may replace current crypto leaders. Larry Fink has stated the bond market is undergoing a transformation through tokenization. Confidence in the dollar is diminishing, and BlackRock's involvement in policies contributing to this erosion adds credence to Bitcoin through its spot Bitcoin ETF offering.
Right, but hasn't the technology sort of diverged from the value of the digital coins? I mean, I don't know a lot of people who use the blockchain. That's the Bitcoin technology to transact. I know a lot of people who hold Bitcoin. You don't hold Bitcoin, right?
I don't own anything other than mutual funds and
BlackRock,
BlackRock shares.
Okay, but you see what I'm saying? There's been advancement. There's a utility, it seems, out of nowhere about this digital coin. I don't see the utility in the underlying technology, and isn't that bad?
Well, no, I actually believe the underlying technology is fantastic because the blockchain will help you accelerate the processes of transactions. The blockchain will help you identify. I mean, let's be clear. If you have a pure blockchain and you have knowledge of who the buyers and sellers are, we could then, we don't need custodians anymore. Okay. We don't need, the whole process of finance. Some of the intermediaries are broken down. And so this is why we're all studying.
There, but we're not there.
We're not close to there. But it's an advancement of technology. I mean, it's no different than the spirit around AI and what AI can do.
Fink says the underlying technology is fantastic because it removes all the middlemen, no more custodians, and knowledge of all buyers and sellers. BlackRock made their fortune with AI. AI works by data, and blockchain are data-generating machines. Public chains offer the utility that Fink is describing. It also removes those smaller banks that he said needed to be weeded out. His vision is not Bitcoin, it's chains with utility. The traditional economy is undergoing a period of stress.
And the one final note I will make is that if you think about the benefits of digital money, there are huge potential gains. It's not just about digital forms of physical currency. You can have programmability, units of central bank currency with expiry dates. You could have, as I argue in my book, a potentially better and some people might see it, or a darker world where the government decides that units of central bank money can be used to purchase some things, but not other things that it deems less desirable, like, say, ammunition or drugs or pornography or something of the sort. And that is very powerful in terms of the use of a CBDC.
We are undergoing a transformation in the financial world. Public chains play an important role. The debt is adding up, and we're going to see the consequences from it like we saw in 2008. This entire system is built on leverage. When the house of cards falls, they can implement lower leverage ratios and new rules. That's where central bank digital currencies come into play. Digital banks or financial institutions will have tokens directly from the central bank. There will be complete transparency in the banking world. The designs the IMF and the BIZ offered for cross-border CBDC systems require the big banks and the central banks to partner. The reason central banks have been private from the get-go is for a system of checks and balances. It's to stop the moral hazard of government merging with the banking sector. A CBDC is just that. What difference does it make to the dead, the orphans, and the homeless whether the mad destruction is wrought under the name of totalitarianism or in the holy name of liberty or democracy? Gandhi. Thanks, everyone. I hope you enjoyed the show. Please take a moment to like and subscribe. If you enjoy content like this, please consider joining my Patreon or my Ghost site, dmjr.ghost.io. Both links are in the description below. Thanks, guys.